for any American, there's about a 68% chance that they'll need long-term care at some point in their life. For a couple,
wow,
that figure jumps to almost 90% that at least one of them will. The terrible part is that a lot of the folks who are getting hit with these premium increase notices are no longer insurable.
you might have cheaper premiums now, but when you actually need it, your premiums are going to increase at a time when it's least convenient to do so.
The insidious thing that's kind of happened in the background now is these carriers are...
Hey everybody, welcome back to Remnant Finance. It is coming up at the end of February here, and we've got a special guest in the house today, my buddy Travis McBride, fellow Navy helicopter pilot turned financial strategist, in a similar niche as us, but has got a little bit more of a comprehensive suite of things that he offers. So we're going to do the first of hopefully several podcast interviews. Today we're going to focus on long-term care, what it is, why you should think about it, or why you might not be in a position to think about it, how you should consider it at different ages, different stages in life. For me, this came about because I want my parents and my in-laws to have this conversation, because the more, as we experience more and more in the life insurance space, obviously life insurance at the core of it is the statistics and science around mortality, right? And so you really have to think about and deal with your own mortality and obviously the mortality of others. And so for our parents' age, if you've got retiring and aging parents, the cost of healthcare is skyrocketing. And it's becomes an enormous, all-consuming expense for a lot of seniors and retirees right now. And it's also the reason that a lot of retirees who have followed the conventional plan and done well by all metrics, well, they weren't writing in a healthcare budget that's 10x what they might have assumed at the beginning, if they wrote it in at all. And so it's a very important thing to think through, and while your parents are still in a position to get this coverage. But I initially booked a call with Travis to discuss LTC, long-term care just for myself, so that I could say to my parents, hey, I'm a little bit smarter on this now. I can't do it, and I'm not going to be the expert on it, but I have someone that I think you should talk to, and here's why. But we wanted to make this a recording because I think this is a valuable thing to bring in. So anyways, I'll pause there. Welcome, Travis. And if you can give us a little background about yourself and how you got into this.
Hans, what's going on? Yeah, Travis McBride here. Great to be on the podcast, and good to see you again, man. And kind of funny how 10 years later now, changed from flight suits to insurance here. But background: born and raised Southern California. Finished college. Wanted that sense of camaraderie, a little bit of adrenaline still, because I played a little small college football. So joined the Navy, got my pilot contract. You and I went through the same sort of flow through training there. Ground school in Pensacola, Florida. Flew some small little rinky-dinks, and then primary flight school. I was a T-34 guy. Were you T-6?
T-34. Yeah.
Okay. All right.
Yeah.
Cool.
Corpus.
So, two of the old breed. Corpus T-34 helicopter advanced in Pensacola, and you and I both came out here to the Fleet Replacement Squadron in San Diego. I was HSM 71. Did about 1.5 deployments. Full one to South China Sea was my first one, and then did all of workups and about the first 2.5 months of my next one, and then got follow-on orders to be an instructor out of the East Coast FRS in Mayport, Florida. And did the CAG rep tour up in Virginia Beach, and then got out. In the meantime, while all that was happening, a couple of my college football buddies started this brokerage. And I had my foot in the door of being a commercial pilot. I had like a conditional job offer from SkyWest at a regional, and I was actually at my bachelor party sitting around, and my one friend who started the brokerage I'm at now was like, hey, why don't you come over here and try this out? Let me tell you a little bit about it before just committing yourself to being a commercial pilot. So jumped in with both feet, haven't looked back. And that is kind of a little bit about me.
So what does this brokerage do? I know obviously insurance, that's why we're talking, but an LTC, but what what's the brokerage? What's the target client that you guys work with?
Yeah.
And what kind of training did you do to get there?
Yeah. So, basically, I sat, with a team that's, been doing this for, the better part of 2 decades. The first year and a half was monkey see, monkey do. Why this product? What's the situation here? Just, analyzing hundreds and hundreds and hundreds and hundreds of insurance cases, and kind of learning the ropes and the processes from some of the best in the business. And basically, we are a insurance concierge. You hear, general agencies, brokers. Typically they're more of, an insurance producer or a financial planner. Their clients have an insurance need, whether it's life, long-term care, annuities, or disability insurance. They kind of, typically financial advisors are more focused on, being in their Schwab software and making trades. They don't want to deal with insurance. Insurance marketplace, of course, as you know, is clunky. And if you're not in it all day, every day,
Mm-hmm.
it's tough to kind of keep pace with the changes and know, where the value is at any current moment. So that's where they tag us in. We're their kind of go-to specialist for financial advisors, CPAs, and other insurance producers who operate on a more client-facing level. So we're kind of business to business in the food chain, and as opposed to other GAs that are more of order fulfillment takers, and just hey, I need XYZ, and you fire that into a 1-800 number, or some sort of email where there's no relationship, and some order taker sends you a 60-page life insurance illustration with no context 5 business days later, and it's left on the advisor to try and figure it out. We are hyper personalized, and so white glove. We take the design, we extract, we build it based off of the producer's unique wants and needs, and the client's unique wants and needs. We build it. We quote the marketplace, find the the top 3 sort of strategies or 4 sort of strategies that meet the producer and the client's objective, and from there, we distill all the information, have a couple meetings. We can deliver that in like a Loom video for them so that they can refer to it. We even jump on the call with the with the insurance producer or the financial advisor or CPA and the client to talk through it as their like dedicated in-house expert. And so we just do a lot more than your typical GA. And against a backdrop of on our side of the business, your traditional life insurance brokers being acquired and venture capital coming in and outsourcing all the service work to, and offshoring it to, the Philippines, or putting it back on the advisor or producer who already doesn't have time to deal with it or, be an expert on it. We're kind of sitting against the tide and just gobbling up a ton of market share because people want and need, a white glove presence there.
Yeah, that's solid. Yeah, our approach with clients, and something I tell every client is that every client, as far as whole life product goes, is I want this to be the asset that you understand the most. So we're going to take the time to educate you. Because if Brian and I both die tomorrow, I want you to be able to look at your policy and know exactly why you have the riders you do, what they do, the mechanics. So like that is a conversation that we are very intentional about having as far as trying to start with the foundation of education. Yeah. But that's because we're a one-trick pony. We do whole life insurance and then convertible term for infinite banking. That's 99% of what we do. Occasionally, we might have someone who just wants a regular term, just wants a standard whole life policy, something like that. But for the most part, our calendar is popping at the seams right now. Like we're about maxed out with people because they understand the idea of considering controlling the banking function, trying to utilize your whole life policy for a specific purpose. So we have that one element that we are professional experts in, but if we were doing a bunch of other services, if we had a whole suite of things, and like you said, for a CFP, for a financial advisor, primarily their focus is on the growth side.
Yep.
We want to be experts on the protection and saving side, and help. We kind of take the opposite approach, where if you want, people come to us and talk about what they want to do for investment strategies, and of course we're not financial advisors, so we have people we refer to for different strategies and assets that they're experts in, and we want them to get the best from that individual. But with our one specific focus, we are experts. And so if we were a jack of all trades, if we had a wide range of services that we directly offered clients, we
Yeah.
probably wouldn't have the ability to focus so directly on life insurance, and that's where we would go to someone like you. So you're more interacting with advisors rather than clients directly. But beyond life insurance, what else are you guys focusing on? What do advisors come to you with? What's the basket of products that they need for a client?
Yeah, and obviously, within life insurance, there's a multitude of different strategies for your young professionals. Just bought a house, family. Simple, cheap term is typically what they're looking for. All the way to your older folks who have estate liquidity sort of strategies and need a much larger permanent life insurance policy, and everything in between. But outside of life, I think it kind of comes full circle. We do a lot of long-term care planning and consulting with our advisors for their clients who need it, disability insurance as well, and of course annuities. But kind of focusing on long-term care, I think it's the iceberg that's sitting out there in the dark that a lot of folks don't really think about until, unfortunately, it's too late.
Mm-hmm.
And I tell you firsthand, a couple years back, we tried to do a direct to consumer long-term care sort of marketing campaign, and it was, our phones were ringing off the hook. The only problem was 99% of the calls were for people who had fallen down, or had mobility issues, or had basically gotten to the point where they're forced to the discussion, but unfortunately it was too late in most
Right.
cases. Obviously, you can't go out and just get free insurance and get insurance carrier to pay for someone who's going to go on claim day one, right? Like that math
Can't buy
doesn't.
fire insurance after your house is burned down.
Exactly. So we found that the direct to consumer approach was just we're spending so much time with folks who just were uninsurable that we kind of had to shut it down. However, like it really did function in a way to let us know, like, hey, this stuff is not thought about until it's too late often, and a lot of people just don't really have, they underestimate the cost of long-term care. They underestimate the the probability and just the pure statistics floating around about Americans' long-term care needs, and unfortunately, like, are left kind of scrambling.
Yeah. So let's get into what long-term care is, why you should be thinking about it, when you should be thinking about it, how the way you think about it changes. If you're our age right now, you're mid. I'm gonna say we're still, I don't know, 37. I guess Is that technically late 30s?
Yeah.
We're,
Shoot, I
we're
don't.
we're early. We're early late 30s or late mid 30s. But
I'm 37 as well, and
okay.
I think with our history of the helicopters, but our backs are probably more like 70-year-olds. But
Yeah.
anyways,
Yeah. Okay. So we are. We'll say late 30s.
yeah,
But if you're not anywhere near long-term care needs, right? Let's say you still have decades, whether you're 30, 40, even 50, you're not really looking at long-term care as a pressing need right now.
yeah.
What is long-term care? What's the product? What's the chassis? What that it's built on? And then we'll get into a little bit more of riders and individual considerations on structuring a policy. But let's just do a 101 of long-term care.
Yeah, absolutely. So, hey, long-term care, it's essentially insurance to cover to where an insurance provider will pay for long-term care expenses. Kind of zooming out, touching on a couple statistics, right? For any American, there's about a 68% chance that they'll need long-term care at some point in their life. For a couple,
Wow.
that figure jumps to almost 90% that at least one of them will need long-term care. Okay.
Yeah.
The average female duration of long-term care is about 3.7 years. Okay. The average male duration, guys, we treat our bodies horribly and much better than our female counterparts, or much worse than our female counterparts, and we don't last as long in long-term care because of it. Average male duration is about 1.8, around 1.9 years. Okay.
Wow. So you're just saying that we just die sooner. Like,
yeah,
the need
last.
isn't any less. We just die. We just don't last. Wow.
Yeah. And about 55% of long-term care claims are for cognitive issues. Okay. As folks are living older and older, the risk of, memory care, dementia, Alzheimer's increases as folks age.
Yeah.
So, again, back to your initial question, what is long-term care? Hey, it's getting a life insurance company to pay for long-term care needs at some point in the future. Hey, you have car insurance in case you get into an accident. Everyone has to have it because the government forces you to have it, but the government doesn't force you to have long-term care, even though the statistics say you probably should.
Yeah. Now, what specifically is this? We're talking about in-home care, retirement home, like
there's
skilled
a
nursing
range
facility.
of again, informal care, home health care, assisted living, and then your full-on nursing facility, right? And this is kind of where it gets tricky. There are different ways of ensuring that long-term care need, and that kind of brings us to our three main distinct sort of ways to address the specter of long-term care. First, you have your traditional long-term care insurance, or people in the industry refer to it as LTCI. This is your pay-as-you-go. It's just like car insurance. You have it if you need it, but those premiums go out the window. There's no like cash value or account value component. It's typically the most cost effective, right out the gate. However, again, and again, these are all generalizations, but there's no way to recoup your sunken premiums. It's use it or lose it. Okay.
Is it increasing premiums with age, or do you lock in a fixed rate based on when you start?
Typically, traditional LTCI is a non-guaranteed premium. And for the folks listening out there, there's two major things that I want to kind of address. If you don't take anything, and this is one of them. If you don't take anything else from this podcast while you're kind of doing your education on long-term care insurance, you have to ask your broker or your financial advisor. I hope that's me one day, but if it's not, that's okay. But ask, are the premiums guaranteed?
Yeah,
because
as in fixed and not increasing.
Exactly, because what we've seen in the traditional long-term care insurance marketplace is that in the 90s and the early 2000s, when these products were kind of initially rolled out, insurance carriers based the premiums off of mortality tables. Okay, life insurance mortality tables. Now, turns out long-term care claims and risk are completely different than life insurance risks, right?
Right.
And what happened was generally these carriers mispriced these products in favor of the clients.
Mm-hmm.
Okay. And so folks who bought policies around then, got a ton of value. They just do not make them. They do not price them like they used to. And, because
what time frame was this again?
90s, 2000s.
Okay.
And because they, misprice them generally in favor of the client, if you have a policy from them, you're probably getting letters from the insurance carrier. Hey, sign here. You can, choose 1, 2, 3 option to reduce your premiums by, a reduction in death benefit, or I'm sorry, a reduction in LTC benefit. You could reduce your premiums by 50% or 75%. They're doing this because they're gaining leverage. So if you have one of those old policies and you're getting these letters, I would suggest generally, let us review it, but generally my guidance is most likely going to be do everything you can to hold on to that policy.
Yeah.
Okay.
Yeah.
There used to be, and then specifically here in California, I think around 17, 18 carriers that were all, top rated and very competitive in the traditional long-term care insurance marketplace. There's maybe 2 or 3 now. Okay.
Yeah. Because you can't sustain that business model if you're over.
No.
If you do the math wrong, that's the whole point of actuarial math. Now, when I talk to, like, for instance, starting to have this conversation with my parents, hey, do you guys have long-term care? Have you thought about it? And one of the things I've heard commonly from people their age is maybe there was a period, was this post that window of time where they're overvaluing the policies? Did they do a reverse course and make them bad, like really undervalued products? Because that seems to be, when I talk about LTC with folks my parents' age, it seems to be, I've heard that these products are very, they don't pay out. Like, did the pendulum swing back, or was there a window of time where they were not good? Effect, I mean, broadly speaking, or is
not broadly speaking? I think the consumer was used to having so much value and having the option to have a policy that paid infinitely for long-term care and for a reasonable price, that once the carriers got that data and realized actuarially that they had mispriced these products, the pendulum, of course, rapidly swung back to normalcy. A lot of carriers exited that line of business completely, and because of it, the subjective, like, is this policy as good as the old one? People tend to, obviously, they're more expensive, so they're not as good in the client's eye, or for the client. So I would say, like, actuarially the value is still there. However, relative to those old policies, they're they just don't make them like they used to.
Right. Yeah. So that this is still all in the traditional LTC bucket, effectively.
So
okay,
now,
so we've got,
that is your traditional long-term care insurance. It typically, they only, they'll pay, and again, every carrier is a little bit different. Every state's a little bit different. Of course, life insurance products. And when I say life insurance products, we're talking life insurance, long-term care, annuities, and disability insurance. The 4 core products that life insurance carriers distribute. Okay. But life insurance is all regulated at the state level. So again, these are all generalizations. You have to reference the specific state, specific company. But generally, traditional LTCI policies will typically pay like 50% for informal care, if they have it at all, if they have that option at all, or home health care, and then they don't pay 100% of that daily or monthly benefit until you're in like an assisted living facility or nursing care.
Would it be fair to make the analogy of like a traditional long-term care is sort of like 1 year renewing term where you're basically just renting insurance, and if you don't use it, there's not, unlike a whole life policy, you're not accumulating any value as you go. You're not getting any quote equity, or it's literally just a sunk cost as you go, and if you need it, you tap it, kind of thing.
Exactly.
Okay.
Exactly. Yeah. No, you hit the nail on the head. Now, going back to the mispricing, right? And the non-guaranteed nature of these premiums. The insidious thing that's kind of happened in the background now is these carriers are there's folks who call us who are getting 50, 100% premium increase notices over the next 4 or 5 years. And, they got the policy 10, 12 years ago, and now they're worried about being able to afford it, especially once they've transitioned from the accumulation stage to the decumulation stage of retirement, and they're living possibly on a fixed income. They're looking at their premiums increasing by 100%, and they're worried. Hey, can we go out there to the marketplace and get something better? Well, the terrible part is that a lot of the folks who are getting hit with these premium increase notices are no longer insurable. So they're kind of stuck having to either continue paying for a product where the premiums are increasing rapidly, or not having insurance and praying that they don't get their assets wound down.
Yeah. So that's that speaks again to how important it is. Question number one, everyone should take away: are the premiums guaranteed? Because we just sum up traditional, we've got pay as you go, no cash value. It's the most cost effective, but it's a non-guaranteed increasing premium. And you might be getting those letters down the road, which sounds very much like the conversations we have about IULs. Is that, hey, it was a great deal for a while, and now it's prohibitively expensive, and I'm gonna have to surrender it. So, do you guys typically do traditional LTCI if people want it, or is it really something that's kind of gone away, like the UL chassis in a sense?
The demand for traditional LTCI has decreased significantly as consumers become smarter on these products. However, for me, if someone wants to learn about long-term care, I'll typically show them traditional LTCI premiums at a great carrier. I'll show them a couple other product chassis that we're going to get to in a moment. But it's not for me to make that risk decision for them. And I'm not saying the traditional LTCI policy is generally good or bad. However, I just want people to know, and I make this explicitly clear, that if you're going to go this route, it's the least out of pocket now, but please, please, please understand that you are shouldering the risk of non-guaranteed premiums and the historical track record of premiums going up in the future. And if you're 50, it might have, you might have your premiums increased 4 or 5 times, and you might be, then that might be fine for client A, not fine for client B. But again, my job is to just ensure that they know how the policy works and know what they're getting into. Because unfortunately, what I see is too many folks just enter the fray themselves, and they buy something that they don't understand.
Yeah. And so that gets in. So it's all about risk pricing. If we had perfect information, so many of these decisions there'd only be one decision, right? If you knew you were going to die in 5 years, for sure, I wouldn't sell you a whole life policy when I could achieve the same thing with a term policy for much cheaper. If you die during a term, well, it turned out that term was the most effective way to capture that human life value and provide the protection, right? With perfect information, there's a scenario where term makes the most sense.
Yeah.
With perfect information, I would imagine, based on this, that the person where this might be the best outcome is someone who's super healthy and turns out never actually needs that care. I mean, I guess if you're not going to need that care, then this would be the most cost-effective way to do it. But again, do you want to take that risk? Because the risk of being wrong here is enormous. And going back to our core philosophy, protect, save, grow in that order, that being the proper financial order of operations. Because if you have it in a different order, the subsequent ones can undo. The ones prior can undo the ones that come later. So you could have a phenomenal portfolio of growth assets, but a savings emergency can disrupt that compounding curve, and you might never recover that. Or you could have a great savings and emergency fund, and you could have a great pool of assets that you're growing and investing in your growth component. But if you get sued, right, a lawsuit happens every minute in America. If you are one of the people that your college age son hits somebody with a car, you get sued as the owner of the car, whatever, these contingencies that we don't really think through when we're thinking about growing our money and investing in a 401k till 65, whatever you're doing with your money. We're not really thinking about what if someone is driving my car, hits someone, and we get sued for $2.5 million and we lose the case. Well, now all those gross assets are gone and all the savings is gone. Or what if you get a disability? It looks great with these projections if you put X amount into your brokerage account every year, but if you don't make income coming in, are you protected on the disability side? And that's another conversation we want to have soon, is disability income, disability insurance. But here you could have phenomenal savings, you could have good life insurance protection, disability protection, but if you're not properly set up for incurring a lifetime cost of, I mean, just imagine the cost of going into a long-term care facility today. The monthly cost is going to eat through investment gains. Like you can't, I mean, you have to have a very robust portfolio to be able to survive that if you're not adequately prepared. And so the risk of being wrong here, or the consequences of accepting too much of a risk and being wrong can be very high.
Absolutely. And, it's again, it might be surprising, but most of the people who purchase long-term care insurance can afford it and can self-insure,
Mm-hmm.
but they kind of understand the other people's money concept, right? If they're
Right.
young enough, typically, late 40s at the earliest to, 50s and early 60s, and you're insurable, well, why not spend a couple bucks on insurance now, vice facing a problem where in the future you might have a great investment account. You may have worked super hard to build that up and accumulate and lived an extremely strategic and disciplined life, but you don't have long-term care insurance, and on the low end, we're looking at $5,000 to $6,000 here a month in Southern California, up to as high and luxurious as you want to get, but 12, 15 grand a month for a nursing care facility. How fast is that retirement going to go? Because again, now you have to realize when you're looking at those numbers in your 401k or your IRA, you have $2.5 million. Well, that's all taxable. We all owe money to Uncle Sam in order to get those liquid dollars out of there. So, you are, depending on your tax rate, say you're in 20 to 35% tax bracket, you are paying $1.25 to access one liquid dollar out of that retirement account in ordinary income tax every year. So that $2 million account is actually a lot less than a lot of people actually, that people realize, and it goes really fast. And why would you not use, some pennies on the dollar to insure that asset? Because another thing people don't realize is, if they have kids, what happens when they pass away with, IRA or 401k? Well, the investments, the kids inherit that and get a step up in basis, right? So you can basically preserve that step up in basis by not winding that down and paying taxes on all that money in there.
And you're talking about in a scenario where you're either withdrawing early before you reach the retirement age, or you're there but you're in a traditional account. Obviously, like the person listening who's like, well, I'm 60 and I have a Roth, like then I'm not taking that tax hit at that point. But if you're prior to 60 or 59 and a half, and or you're in a traditional vehicle, then you're paying either a penalty or a tax, and so there's like that's what you're referring to, like early
Yeah, no, I
withdrawals.
mean as
Traditional.
you withdraw from an IRA, regardless of whether you're using it for LTC or to go on your vacation, enjoy your retirement, you're paying taxes on those dollars, right?
On the traditional ones, yeah.
Yeah, on your qualified accounts. So yeah, and that's the thing I think a lot of people don't focus on, and those are for the people that kind of have assets, who think, oh, I can self-insure. Well, I think it's at least worth considering. Gaining leverage while you're young and healthy enough so that you don't have to wind those assets down and pay all those taxes and fees to Uncle Sam when you don't when you could, kind of do that, you could kind of do that on your own terms.
Right.
Now, I think for the folks, unfortunately, who don't have, $1.5, $2 million sitting around in their qualified accounts, where does the funding typically come from for long-term care? It comes from the fire sale of a primary residence in a lot of cases. And, and this is sad to see because a lot of time, it's the individual's kind of left scrambling, or their son or daughter or whoever has to figure it out for them, especially if it's some sort of cognitive issue. And you don't have a ton of time. You have to get liquid dollars now. They're in a rush to sell the family house, and, it's not an ideal situation.
Yeah, for sure. And and one that and that's why we have these conversations now, so that you put it on your radar while you're still insurable, while it's feasible, while you can get reasonable, hopefully guaranteed premiums, right? And so let's go. All right, so that's traditional LTCI.
Yep.
What are the other two vehicles that, or the flavors of this that make it more, maybe either more palatable or more sustainable for more people?
Yeah, so basically, a traditional LTCI in the wake of kind of what happened to the traditional LTC marketplace, you can now tack on riders to a life insurance policy. Okay, where you can make it kind of a 2-for-1 rather than just a death benefit that pays only upon one of the insured passing away. You could use that while you're still living by tacking on what's called a long-term care rider onto the policy at purchase, okay? Which allows the acceleration of that death benefit to the insured while they're still living to use for qualified long-term care costs.
Now, is that different? So every policy we write includes an accelerated death benefit rider, and to one of the companies, it's triggered within 3 different scenarios. There's a list of nine events that qualify, like stroke, different things that meet these 9 individual types of medical emergencies you could have.
Yep.
Those qualify you to access some amount of the death benefit. The second is chronic care or chronic illness, which is defined as 2 of the 6 activities of daily living. If you can't perform 2 of those 6 ADLs, then you qualify for an amount of accelerated death benefit, i.e. receiving that death benefit while you're alive. And then third, a terminal illness, which they define as a doctor diagnosing you terminally ill to pass within 12 months. Each of those comes with a different amount you can access, but that is a free rider included on every policy we write. What's the difference between your standard accelerated death benefit rider and then a specific LTC rider? Or is it just that like if you have the accelerated death benefit, you don't need this additional LTC rider?
So they are similar, but they're not the same, right? Those are benefits created by the insurance company. Now, typically, the claims process is a little bit more scrutinized, and it's a little bit more difficult because if you have an actual long-term care insurance rider approved policy, that rider and the claims, the ability to go on claim is all hashed out and approved at the state level, okay? And the premiums that are used to pay for that rider are generally tax deductible, which
interesting.
Which is not for the just kind of off the shelf accelerated death benefit and terminal illness riders that kind of come standard with a lot of policies out there.
Okay, so tax deductible element, that's definitely something. Or do they keep that in like a separate bucket, or is it all in the same? Okay, so you pay the LTC rider premium, and that is segregated from your policy benefits, and it's almost like a side account with a separate purpose. But then you kind of reach into the death benefit if needed. Is that?
Yep. And typically they'll, the qualifiers are standardized, 2 of 6 activities of daily living and cognitive issues, typically Alzheimer's, dementia. And again, the pathway to go on claim has all been hashed out and regulated at the state level. Vice, the carrier, just kind of sprinkling these features into a policy that aren't regulated by anybody but the carrier themselves when it comes to the off-the-shelf kind of accelerated death benefit riders.
Okay, and I pulled up those 6 activities of daily living: just bathing, dressing, toileting, transferring, which is getting in and out of bed or chairs.
Yep.
Continence and feeding. And so if you think about your grandparents in their final years, were they able to bathe, dress, use the restroom, feed themselves? Like 2 of those things that if you can't do that, that is enough to trigger these riders to pay out. And it's also enough to trigger that accelerated death benefit rider to pay out. But again, there's some differences in how these function. But those are, I would imagine we could all think of someone in our lives who has been unable to do 2 of those things later in their life, right? I can't imagine anyone doesn't know someone who's lived to the point where they need that. And so having that there, it's like maybe you're being able to like address and transfer yourself, like maybe your grandparent needed that, and that might not have been enough for you to justify putting them into a long-term care facility because, hey, we can deal with this, we can help, like we're going to have someone here. But if you have the option in that event to now tap these funds, well, why would you not? Like that would be a great value. That would have been a blessing to a lot of people when their grandparents or they themselves or their parents experience that. Like, hey, maybe we wouldn't justify the out-of-pocket cost because we can just suck it up and manage this.
Yep.
But if I can get a large windfall because of this, that will certainly help, and that will allow us to make it makes our decisions a lot easier as to how we want to provide this care.
Yeah, and I think, there's another kind of emotional aspect to it too, where, a lot of folks getting these policies, they don't want their family members to have to, deal with some of the things that come along with needing long-term care. They want to kind of preserve, some of the dignity and have a professional, help them bathe or whatever, go to the bathroom or whatever it might be. And they don't want to place that burden on their son, daughter, niece, nephew, whoever it might be. And, I think that's something a lot of folks don't typically give a lot of thought to as well.
Yeah. And it's like, there is an entire, my wife is an occupational therapist.
Yeah.
And so she has a master's degree effectively in how do you help people with those 6 activities of daily living. Now, I'm not going to be able to do justice to the OT profession, but from what I understand, it's effectively how do we help people do these things, whether you're recovering from an injury, elderly, child with a disability, something like that. And so there is more. I mean, when we were in the hospital with my daughter, when she had her eyebrow injury and had to go under anesthesia to get the 30 stitches, right? So we spent a long time in the hospital that day, and just watching I don't know if it was the nurses or the orderlies doing transfers for people, how they're doing the wheelchair. My wife was like, this is not what that person needs to be handled right now. So there is a whole science behind how to do these things effectively so that you encourage development and don't make anything worse. And again, there's way more to it than that. I just, it's been a while since she's talked about it because she's not practicing at the moment. But
Yeah.
that is an entire field of master's study just to be competent at helping people with those 6 activities of daily living. And so you might be like, hey, the cost of this, we're going to have to make a decision that we're going to suck it up and do it ourselves because we don't have a choice. We can't pay for it. But it is not as, if you are able to get professional care to do that, like if you can get an OT to help with those things, that is going to serve this person much better than you trying to do it yourself, or you just getting some in-home help from someone who is kind of just like a nurse, like a live-in nurse or something, because they're not going to be qualified to the level that you can be in those things.
Yeah. Yep, absolutely. No, great point. And so I think that kind of sums up our second avenue, right? You can tack a long-term care insurance rider onto various different forms of life insurance. Okay. Typically,
can that be done? That can't be done retroactively, I'm assuming.
No, typically not. Again, there's nuances at every carrier, so these are all generalizations. But I would say typically this is for a client who is life insurance focused, but wants that kind of 2-for-1 ability to flip the switch and accelerate some of that death benefit in the form of tax-free LTC dollars if needed while they're still alive. But
okay.
The majority of the premiums are going towards the life insurance policy. Okay, so it is more life insurance focused. Okay, third one is what's called asset-based care, or a hybrid policy. Now, this is a policy typically utilizing whole life or a combined annuity with whole life. So there's some stuff going on under the hood, but typically the major this is using a pool of assets and moving them from maybe a CD or brokerage account and putting them into a hybrid linked policy where you still have control over the underlying assets, but now they're being leveraged by the insurance company in a way to provide you long-term care dollars. Now, a lot of times it could be a single premium. You can do 10 up to a 20-year pay on these, but the biggest thing here is that the premiums are fully guaranteed, meaning they'll never increase. And you typically get, 2 to 3x leverage. Okay.
When you say 2 to 3x leverage,
so for like a single premium, if you have, say you have $100,000 sitting in, an old annuity, and maybe, there's a large taxable gain in that annuity. Well, we could transfer that into one of these linked benefit policies or hybrid policies, and it moves over here. Say it's $100,000. Well, typically you can get 2 or 3x depending on underwriting that benefit. So that $100,000 pool can turn into $300,000 of tax-free money to be used for long-term care should you ever need it.
Now let's say that's our example. $100,000 paid today. Someone gets a policy with you, puts $100,000 in.
Yeah.
We start out with $300,000 of potential long-term care use funds. So a few questions. Does that grow over time? Can we start tapping that whenever, or is there a time period where you have to wait? Is there an age milestone you have to hit before you can use this? And then what happens if you pass without using these benefits? Let's just kind of cover some of the using that as our default example here. 100 turns into 300, and then what are your rights with this policy? When does it trip, et cetera?
And we're using, and I know that $100,000 premium. This is just an example, because you could space the premiums out over 20 years and pay a much smaller premium. But generally, inside the hybrid policy, you have liquidity and control of the underlying assets. If you never need to go on long-term care, you get struck by lightning, well, you get a death benefit that provides typically, kind of like a bond-like positive IRR return on the premium. Okay. So it is not super death benefit focused though, but
right. So it's not like you would just get you end up, you do this 100,000, or you space it out, and just for simple math, you for 20 years, you pay $5,000 a year to get the same 100,000, even though time value of money, it's not going to be exactly apples to apples there, but let's just say that, and then you have this $300,000. That's not a death benefit. That is a long-term care benefit. So it's not like you spend a total of $50,000 of healthcare coverage expenses, and then the remaining $250 you die. It's not like the remaining $250 is a life insurance death benefit. Like, that's not what we're paying for here directly. But there is some element of death benefit protection, premium recovery.
Exactly. So, for your example, $5,000 over 20 years, right? Typically, and I'd have to use my quoting software to look at carrier rates, but you're paying that, you're typically going to have a death benefit of somewhere around, $115,000, $120,000. And, you'll get like some serious leverage on those dollars that go into this policy. They come out tax-free. Underneath the policy, you have liquidity and control. There's typically a surrender schedule, but there's a point where, in a lot of these where, you have 100% control over those underlying assets and can liquidate the policy and get your money back out, walk away in a lot of cases if you want.
Let's go back to my example there. You're paying the $100,000 over 10 years, 20 years, one time, whatever it is. You incur $50,000 of medical expenses. Is there a point where that death benefit, you said, say it's 115, right? And again, we're not doing this for the death benefit. This is for long-term care. And so, but it does come with effectively premium recovery. You're going to make a little bit of a return on that premium, not much, but that would still be tax-free to your beneficiaries, recovering the cost of these. And so the money doesn't leave your family, it leaves you for a period in exchange for long-term care protection. But is there a point where, say say I had a $300,000 death benefit and a $50,000 outstanding policy loan when I die, well, my death benefit is going to be offset by that policy loan, right?
Right.
Is it always going to be that your 100 in our example gets you 115 death benefit, or does that death benefit get reduced based on how much you use of that 300?
Great question, right? So say, you've paid premiums, you have, a pool of 300 and something $1,000 for long-term care. You have a $100,000 death benefit. Once you start winding the policy down, that first $100,000 comes, reduces that death benefit.
Okay.
Eventually, right, if you stay on the care long enough, depending on the policy, right, there'll be zero residual death benefit if you burn through all those dollars. But now as that gets spent down, you have the firepower of 3x leverage in most cases, where that policy is going to continue to pay, even though the account value underneath, the underlying cash value of the policy, is zero.
Okay, so we've spent $100,000 in premium for a $300,000 long-term care benefit. It's let's just keep it simple. It's $100,000 death benefit. So if I live my whole life and I never touch it, my wife gets refunded the $100,000.
Exactly. But typically, right, these policies, and I think it's important to realize, you own this policy. So there's underlying account value. And so they're highly liquid. So there is typically a surrender schedule for the first handful of years. But once you get past that, there's an account value that's being credited a small interest rate, and you could cut and run and take that money. And so you have control. It's not leaving you. It's just sitting. It's being moved from, your savings account or brokerage account, whatever it is, into this hybrid chassis. Okay.
But let's say, so going back,
yeah,
in the first example, I died, I hadn't used any of it. My wife gets the 100,000 refund. And again, we're keeping it very simple here.
Yeah.
But if I've taken out $100,000 worth of long-term care from this policy, that you said that first 100,000 would be the death benefit effectively. So there's no more death benefit because I've used 100,000, but I have effectively 200,000 more of benefits. I've already recovered, instead of paying my premium, like I recovered what I've spent in the form of premium in long-term care, but I have another $200,000 of long-term care runway that I built for myself, and now I'm basically playing with house money here. Is that
exactly
kind of thinking through it correctly? Okay.
Exactly. Yeah. Now, kind of getting to I said there's like the two most important things you could take away from this. One, regardless of, if it's traditional LTCI or whatever sort of chassis you're dumping your premiums into, ask, are the premiums guaranteed? Well, on these hybrid policies, the premiums are guaranteed. They're typically never going to go up. Okay. Now, the second most important thing to know, regardless of product chassis, whether it's traditional LTCI or Life Plus LTC rider or hybrid LTC policy, how are the benefits paid out? Now, I've had good insurance. I've had crummy insurance. Having a policy where the ease of use and ease of claim, I think, is extremely important. And the biggest, sort of pain point for people is the policy, is the benefit on a reimbursement mode, or is it cash indemnity? Okay. The major differences are reimbursement, right? You have to get receipts, or the beneficiary or the person who's handling the claims process is going to have to get receipts every month. They're going to have to file ongoing claims in order to get reimbursed for those expenses. Okay. Cash indemnity is, once you qualify, the carrier cuts you a check every single month for the monthly LTC max, and you can use that money however you want. So it could be used to pay for, a relative who might have to take a day off work to swing past the house and do laundry for you, or do the dishes or whatever. Someone who's going to be losing some income because they're having to take time off or whatever it is. The insured can use this money however they want. Indemnity, it's cash that goes straight to you every single month. And typically cash indemnity policies cost a little bit more because the ease of use, they're so much easier to use. They're so much more client friendly once you're actually on the claims process versus reimbursement, where the benefit might look larger and more substantial on paper, but the carrier knows based off the law of large numbers and claims data that because it's more difficult to use, they're going to have to not pay out X amount percent less versus a cash indemnity policy. So it's really important to know, is your policy reimbursement or cash indemnity?
Okay, that's huge. And so obviously someone who's going to work with you to set up one of these policies or to explore it, you're going to tell them, are the premiums guaranteed? And we pretty much want to make sure they are guaranteed in every situation. I can't imagine a scenario where going into this fresh, I wouldn't want a guaranteed premium. And two, how the benefits are paid out. And so you've done that vetting with the companies you work with, how they pay out.
Yep.
And so like we can feel good going in that those questions have been addressed and considered already. All right, let's talk through first of all, if you are coming up on retirement age, if let's say you're 60 plus, you're still in good health. I'm just thinking of my parents right now.
Yeah.
Good health, nothing, no pressing issues right now, but something we need to start thinking about. And then let's go to your 30, 40, 50-year-old. Like, how should we be thinking about this?
Yeah, I mean, so for your parents, right, 60s, they probably have had firsthand experience with this with your grandparents or an aunt or, their aunt or uncle or something like this. They've seen it firsthand in a lot of cases. And if they're young and healthy enough, I would suggest like looking at hybrid policies. They're the easiest to use. They provide the most leverage. Premiums are typically more than your traditional LTCI policies, but you just get so much more bang for your buck in terms of control of the underlying assets and a residual death benefit to recoup the cost of the policy over those years and leverage on those dollars versus your traditional LTCI where it's use it or lose it. And the premiums are not guaranteed.
And that's the thing, like between my parents and in-laws, we're talking kind of mid late 60s to early 70s is the range of the four grandparents that that my daughters have. So it might be cheaper right now, likely, God willing, we pray that, they've got a long time ahead. But it might be cheaper now, but when you really need it, likely in 10 years hopefully still don't need it then, but the likelihood of needing it obviously goes up. And so therefore, if the premiums are going with that, it's like, yeah, you might have cheaper premiums now, but when you actually need it, your premiums are going to increase at a time when it's least convenient to do so. And so there's value in locking in that premium now. It just gets back to the same discussion of like, I'm not going to get term policies for my parents because they wouldn't get term policies because it's so much more to cover this term in life. And so, yeah, you save money with a term, but you're getting the value that you're provided. Same thing with this LTCI. Yeah, you might have cheaper premiums because you're getting less value.
Exactly. A great analogy on the term side of the house, right? Most people have had term insurance their whole lives. Well, once we get to our, the back nine of life, right? Our later years where longevity and life expectancy kind of enter the picture. Does it make sense to buy term that, which is basically a ticket that's, you typically can't buy term that goes past age 85, right? So why buy expensive term that's only going to take you to age 85 when, you do the transatlantic voyage and you have, the policy lapses or goes into ART, which people can't afford right before they're probably going
annually renewing term.
Yep. Sorry. Versus just spending an extra buck or two and guaranteeing that death benefits there upon their passing. Like you said, traditional LTCI, if you're 60, you're looking at a long runway until you're going to have to go on claim. And using the historical data of premium increases, if I was a betting man, I'd probably bet you're going to at least have one possibly multiple premium increases, which is fine if you can afford it, and it's fine if you're okay with that risk. Where people get in trouble is as those premiums increase and as parts start to wear out, they get to this point where they don't want to they can't afford the premiums anymore, don't want to pay for it. Now they're trying to re-enter the marketplace at 75 years old, and they're either uninsurable, or if they are, it's so expensive at that point, and it just doesn't make a lot of sense. So they're kind of stuck between a rock and a hard place. And
Right.
again, my job is not to say that policy is good or bad. I think that policy, traditional LTCI is great for some people, but you have to understand kind of the dynamic getting into it. And if you're okay with that, great. If that doesn't suit your needs, then it's probably best to look at something else.
So what about for our core audience, guys our age, 37, 47, 27?
It depends on kind of your income. I would say, it's very unusual to talk to someone in their 30s pursuing, long-term care. For your general sort of person who's buying term insurance, I think, having a term product with some sort of off-the-shelf rider is probably enough coverage. I would say generally it's, late 40s is, mid to late 40s is probably when you want to start looking at LTC, or that discussion enters the frame.
Okay, so for our age, more this is more for understanding how to have that conversation with our parents and make sure that they're tracking it, because that's when. So okay, so by when would you say, like, what age listening right now who's never thought about this would you say, okay, you're kind of like pushing the clock here, you're late to the party, you really need to get on my calendar? Is that 50? Is it 60?
I would say, once you're in your 60s and, as life expectancy risk starts to, really increase exponentially, so too does long-term care risk. And, if you're 65 and it's the first time you thought of it, you're probably, entering the game a little late. Not to say there's not products or solutions out there where we could find you a lot of leverage, especially if it's just sort of shuffling assets around for kind of a more tax savvy strategy. I would say, 65 plus, you're late to the game. The sweet spot is probably, 50s to early 60s.
Okay. And is there, like, my audience, like, if you're interested in infinite banking, if you understand what we're doing, capitalizing a policy, we don't fear paying premium. We view premium as capitalizing our policies, capitalizing our banking system. So that resonates with all of our clients, obviously, and a lot of our audience. So I'm not scared of paying premiums. I love the idea of insurance. I love offloading that risk and not assuming that I'm going to be in a position or have the willingness to just, self-insurance to me is a myth. All that is just means I have enough money to move it from one vehicle, either a savings vehicle or liquidating an investment, to replace what was lost. It's like, yes, I didn't have to pay premium to do that. I didn't give that burden to the insurance company to cover that loss. But also I had to liquidate somewhere. I had to move. I just moved it from one pocket to another to replace the home that burned down or the car that totaled. Like, self-insurance, it's kind of an oxymoron. Like, it's not self-insurance. It's just having enough to sell something to recover a loss, which it is something, but it's not insurance, inherently and definitionally. And so I'm not afraid of premium. So is there a way that I could, all right, I'm 37. It doesn't really make sense for me to really have a conversation about long-term care for myself right now, but hey, I still have 30 years until I might really need it. And could I just pay a really small premium now, lock it in, let it grow for 30 years, something like that? Or is that not really how these policies are structured?
It depends on the carrier. Sometimes you can purchase it as early, you could purchase it super early. I would say, probably want to pump the brakes until, you're in your mid 40s. I think that's probably on the earlier side of the spectrum. But I would say, again, 45 to 55 is, I think, where you're going to gain your most leverage here. still a lot of leverage for people 55 to 65 as long as they're healthy. Once you get past that, we're kind of back on the backside of that curve where premiums get really, really expensive. But again, it comes down, the main issue here is just, it's understanding leverage, and that this is a longevity and sort of sequencing issue that it's impossible to forecast if any individual is going to have to use long-term care or go on long-term care claim at some point. But we do know the law of large numbers that says, when you pool 1,000 lives together, that a certain percentage, is very likely to have to, go on need long-term care.
Now, one more question. Medicare, like what do you get defaulted into when you are qualifying and receiving Medicare benefits? Does that effectively offset some of this, or is it just another? Is it another government program that's so clunky and ineffective and overfunded but underperform? Like, what is?
Yeah, no.
How do you have that conversation? My parents are qualifying for Medicare. How does that build into their discussion?
Yeah. So again, I would say it's clunky. There's a assumption out there that Medicare will cover your LTC care cost, which is, indefinitely, which is not the case. They typically will only cover for the first 100 days at the maximum. And we've talked about the duration, right? 1.8 years for men, and 4.7 years for women. Or sorry, 3.7 years for women, right? Yeah. At a monthly, rip of $6, $8, $10, $12,000, you're going to be left exposed. And because states and the government's funding this, a lot of states, and you actually could look this up. State of Washington imposed, like, I want to say, don't quote me here, but it's like a 1% income tax on folks if you don't have a qualified long-term care policy.
Really?
Yeah. And
in retirement?
No, anybody. Now, if you have a qualified long-term care policy, you can waive that tax. But the state of California right now, I knew last year there was like a proposed bill that the state legislature, was discussing, and so I think it's coming.
For all ages, like we would be taxed.
Again, don't quote me here. We could do a quick look up here, but the state of Washington has a tax on folks who don't have a qualified long-term care policy. Yeah, let's see here.
Washington State imposes a mandatory 0.58% payroll tax on employee wages to fund long-term care benefits. This applies to all W-2 employees unless they secured an approved exemption by purchasing private LTC before November 2021. This is uncapped, meaning it applies to total earnings. Wow, I did not know that.
Yeah. So, in a and I think this kind of goes along with our, the philosophy you have of our tax is going to be more or less in the future. Well, you have your assumptions. I think states like California are looking at this stuff. I want to say I don't know exactly where it is as of right now, but I think this is coming.
That's like the most classic example. That's a case study in what every Democrat policy is of like, we want to help people, and so let's make it like an intrusive burden financially on you to help you. It's like Obamacare, It's like we want everyone to have health insurance, so we're going to make it harder and more expensive to get. It's like it's so counterproductive, but okay, so now we assume that when something like that happens in one blue state, it's going to keep happening. Obviously, California will jump to any absurd policy. I mean, I get that I could see the intention if we're going to steelman this, like, okay, well, by imposing this friction on you, by imposing a penalty on you, will encourage more people to get something that will actually benefit them, hopefully.
Yeah.
But then you introduce all of the market inefficiencies of, well, okay, now we just need to offer something because people will take it because they don't want to get this penalty, and so we don't have to offer as much. And so I can see a lot of people getting bad LTC from this. I mean, I'm just like thinking through my lens of full distrust of government in general, and in particular hatred for Democrat government. That like clearly this is not going to work out for the people it's intended to work out for. But if that's coming, let's plan for it. But a bigger thought I have, just like, do we think taxes are going to go up or down? Well, let's think through the largest generation in history is retiring in an enormous wave at a time when longevity is increasing, right? Think of like how many breakthroughs in AI have there been in the last 6 months alone, right? Now, I don't know specifically targeting longevity, but a lot of them, devices that can travel through the bloodstream to specifically eliminate one single thing, vice something like a chemotherapy that just washes over and destroys a ton of things, the bad and the good, right? I'm generalizing here. But let's just, like, is it out of the realm of possibility that life expectancies could you see life expectancies increasing with this enormous wave of development that's coming? Right, when an AI tool can read an X-ray, was it 40 times better than a 30-year professional seasoned surgeon can, or whatever. I'm just,
and it's cheaper and faster and scalable.
Right.
I mean, I think all this stuff is coming. Again, I'm not an expert in AI or any of that, but I think it's coming, and I think you have a really solid point.
So let's make that let's go with that assumption that longevity, if it's going to change, it's likely could increase as we get cheap, scalable companies that are targeting healthcare and longevity. Let's just assume life expectancy is going to increase. But we also know that the largest generation in history is retiring in enormous waves right now.
Yep.
So for the next 10, 15 years, we're going to have, if you think of like moving through the belly of the snake, we've got this enormous amount of people that are about to hit and overwhelm both the Medicare system and the medical system as a whole. And so do you think, is there any, like, I couldn't even steelman an argument that says healthcare costs are going to go down as we get this enormous wave of, so our mutual friend, father-in-law was, late in life and needed more and more care, lived with them, and they had a live-in nurse, but that eventually wasn't enough. They had put him into a home here, and they were searching for the best home because money wasn't a factor. It was obscenely expensive by their standards. Like, this is crazy, but they're fortunate in that money was not going to prohibit. So they're like, we want the best of the best because he needs intense care. He's late 80s, early 90s, or early 90s at this point. He needs intense care. Really effectively like 24/7 help with everything, right? Sure. So we'll pay any amount, but the best places were all full here in San Diego. They were looking at North County, but the best place close by, the most expensive, 5-star, everything you need, was fully booked up. They couldn't get them in there.
Yeah.
And so imagine, as the wealthiest generation in history, the largest generation in history is retiring en masse currently, and those healthcare costs are continuing and going up for them. What do you think is going to happen to the cost of healthcare for your parents? If your parents are in that wave, which mine are, they're in that wave of the snake's belly, where like the healthcare system it feels like it's about to be subsumed by demand. So your parents might not have an issue right now, but you might look at this premium, and they might, if they're my parents' age, late 60s, early 70s, like they are coming up on 70, they might have a higher premium than they would have had they tackled this 10 years prior. If they're in that situation, do you think when the time comes in 10 years, when all of the good places are booked up because this large generation is moving through, do you want to be scrambling to find alternatives? Or maybe there's an opening in this one, the one that meets your quality of care that you want, but it is obscenely expensive. And so costs are going up, demand's going to go up. At this point in time, I think that those two are given assumptions we can make. I don't see any counterpoint to those. And so I think this is a critically important conversation to have with your loved ones, because I don't want your parents fire selling their house in order to keep themselves in the long-term care plan that they need. And I don't want you as a listener in your 30s, 40s, 50s, whatever, to have to be selling your assets and interrupting the compounding curve, because you're going to make that decision to do that, right? If it comes to it, parents, our family, and their health and comfort is more important than money. So it's like, you're not going to make the decision to let them just suffer, right? So it's like, it's going to be hard, but we might have to sell this stuff. I don't want people in that situation when we can address it now.
Yeah, and I think you hit the nail on the head. This is a it's not giving money to an insurance company. Maybe for the traditional LTCI side it is kind of, but for your other sorts of products, life, your hybrid linked benefit products, it's a repositioning of assets to address the threat of long-term care, where you get to kind of still have and own these assets and be able to walk away, but at least point them in the direction of a threat that we know is coming.
Yeah, absolutely.
And why asset preservation? Legacy is important to a lot of folks, and why would you wind down a qualified account or fire sale a primary residence and benefit the government by them being able to reassess the property value and kick that up and force a sale and or force the liquidation of a qualified account and drive up ordinary income tax, when we don't have to do that, and we can preserve a lot of those assets for the next generation and keep those tax dollars out of the coffers of the federal government and state government.
And this has been something that Brian and I have wanted. We want to get smart on it. We want to learn. We're going to go through. If anybody wants to have a conversation with Travis and explore your options, whether for yourself, for your parents, for people that you may be supporting down the road, if you want to have that conversation, reach out to me, Hans at Remnant Finance, or just book a call on our calendar and we'll get you in touch with Travis. I want to sit on those calls because I want to learn as much as I can. And one day we want to be able to offer this as something that we are experts in. But right now, we're going to defer to the expert here. And I think it's a critical conversation that we should be having. So Travis, thank you so much for coming on. And hopefully next time we'll have a good conversation. I want to keep talking. We got a few other topics that I would like to pick your brain on for our audience's benefit. But yeah, thanks again for coming on. Anything else you got?
No, thanks for having me. It's been awesome to have this discussion. And yeah, I hope this, at the very least is meaningful for, you guys, your clientele, and, whether you secure LTC through us, and Remnant and me, or, go to your current financial advisor or broker. I hope you can walk away a little bit smarter, a little bit more, with a little bit more knowledge and tactical relevance for the long-term care discussion. And I just kind of, again, want to zoom out and reiterate, if you take nothing else from this conversation, are the premiums guaranteed? And is the benefit paid via reimbursement or indemnity? Okay.
Perfect.
Yeah. And one thing I didn't touch on, I want to just quick plug. Hey, we can grow the benefit by tacking on an inflation rider early that compounds over time, so that we can pay a smaller amount now and buy a less costly benefit now. And while we're not going to need it at age 50, 55, and grow that into something much more meaningful down the line at the average age of claim. So all that being said, great being on, and thanks a ton, Hans, and you guys do great work, man.
Appreciate that. Well, I'll be on your calendar, even if nobody else is, but I suspect that this is something that I'm going to keep talking about it because people need to be thinking about it. And we'll have you on again soon to talk about a few more cool things.
All right. Sounds good.
All right. See you, Travis.
Hey, take care.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.